Well, let's get some analysis on all of this now. We're joined by Dr. Stephen Nash from FIIG Securities. Just wanted to ask you, Stephen, about the commentary and the way the market is viewing whether or not QE3 is now on the way.
I think to some extent the bond market has really embraced the idea of QE3. To some extent you also have to think about who Bernanke is appealing to here. I think firstly he's appealing to the Senate with regard to the approaching fiscal tightening next year. He's trying to moderate that tightening in fiscal spending so that the emerging recovery is not damaged. I think also he's appealing to other people within the Fed with regard to inflationary concerns, and I think to some extent he needs the bond market to be well controlled, yields a little bit lower, so that he can quell fears of inflation. I think a lot of the Fed members are concerned that extra measures will increase inflation, and I think with bond yields under 1.5%, it's fairly difficult to argue that inflationary expectations are out of control. So I imagine that we're going to go lower in yields, possibly towards 1.25 on US 10 years as we approach either an easing in possibly the August meeting, or maybe probably more certain that they go around the Jackson Hole or the meeting that's due after the August meeting towards the end of August, early September.
What about the Beige Book? Because that was out overnight too. What did you glean from that?
Look, I think the general message was that growth is proceeding. There are a few concerns, particularly with regard to the drought in the US, but broadly growth is proceeding quite well. It's not a huge increase that's being reported. Businesses are being fairly cautious in their assessment of demand for loans, but it's good to see that there's an underlying growth momentum in the economy at this stage. But again, the growth is just not enough to reduce unemployment, and I think your point before, arguing that the Fed will move should unemployment stay high. I think it's not a question of should it, I think it probably will, and they will move.
I guess just looking though at some of the data, in particular we saw of course the housing starts number up 7%. I mean, what do you think about the recovery there? Well, is it still on track?
We've seen a gradual improvement in the housing market in the US. I think this is a really important part of the recovery. As the housing market repairs itself and starts to increase in price, hopefully somewhat, I think we're going to see the consumer come out and spend a little bit more. Housing prices are very important to the sentiment of consumers, and I imagine that if they see a stabilisation and a slight appreciation, the idea will be that the worst is over and that they can begin to spend a little bit more than they have in the past. And I think even a small increase in spending would be very welcome right now. So I think you can't underestimate the importance of this housing sector for the US economy.
Another point that it was interesting that you were making when oil was pulling back was that obviously, you know, you can't ignore the fact that that's quite a stimulus as well. Yeah. And I just wanted to ask you, because obviously we've seen this terrible bombing in Bulgaria targeting Israeli holiday makers, at least 6 dead at this stage. The Israeli government blaming Iran. So obviously there's more tensions there in the Middle East. What impact do you think a higher oil price could have?
Well, Iran's already struggling under increased sanctions, particularly the sanctions coming in from the EU. The US has again tried to tighten those sanctions on Iran. They are very concerned about the nuclear situation in Iran and the enrichment that's going on there. I think this development is a serious one. Israel has already indicated that they're going to retaliate. So look, I think oil price right now going up is not a good sign for growth. Again, I suppose that supports the case for lower growth and possibly lower bond yields.
Yeah, and just looking at that, I mean, really interesting to watch the German bond yields with particularly I think it's a 2-year now, negative yields. I mean, have you seen this before?
It's quite unusual. I mean, there was a write-up in the FT yesterday pointing out that 6 European countries' 2-year bonds are negative. So it's not just Germany. The core perceived safe havens in Europe are really being pursued now. Also, I suppose that comes back to the Australian currency, and the Australian currency is being seen as a safe haven. And we've had reports of new central banks buying the Australian currency. I think to some extent it's very difficult for central banks and sovereign wealth funds to find safe havens. This is why we're seeing the Australian dollar so well supported. It's a logical development in the sense that Europe is struggling, particularly the peripheral countries, and there's a real need now to get high quality, high yielding assets, and Australia just has those assets right now, so I imagine that support for the Australian dollar will continue.
Great to get your thoughts as always. Dr. Stephen Nash, thank you so much for chatting with us.
Thanks.